afternoon. I am told that we are good to go here, so sorry about the technical difficulties. Let's go ahead and take a look at this market. The S&P 500, we can see on the screen right here. I added a moving average this week just because I don't like to keep my screen too cluttered up with too many moving averages. But, as we can see here, this moving average, it's the 100-day moving average, and it hasn't really been something that we've needed to look at for a while, but now excuse me, as these markets have gravitated down towards or dropped down towards those 100-day moving averages in a lot of the indices, they become a focal point, a reference point to compare price to. So that's where we are right now. We were down, obviously, another $2.39 on the SPY today, and we're guilty till proven innocent in the intermediate term as we remain underneath this declining 5-day moving average. So there's going to be some good bounces in there, and if you're a day trader who's interested in that, then you've got to focus on the time frame where those are found, which would be more of a 1-minute time frame. And today we stayed pretty much below the volume weighted average price for almost the entire session. Not of course the entire session, but we did gap lower from yesterday. The market tried to recover, and then it was kind of lights out right there as we broke back down below VWAP. So when we back it up to like a 30-minute time frame, you can see that yesterday we had bounced up to this prior level of support in here from earlier in the week. That is the Monday low acted as resistance yesterday, and below a declining 5-day moving average. So intermediate term, you can try to pick a bottom. You can try to pick, as I always say, it's foolish to buy at a rising moving average. You don't want to buy at the 50-day moving average. The 50-day moving average is an inflection point. It's an area. It's something to objectively compare price to. That's really all the 50-day or any moving average is. And then what we want to do is we want to say, okay, well, it's at this 50-day moving average. It's at this prior level of resistance and an area where it seems to be finding support. So does that mean we buy? In my mind, it doesn't mean we buy. It means we observe the market on shorter-term time frames to look for evidence that the buyers are actually gaining control, and that we start to see a little bit of momentum develop back to the upside before buying. Otherwise, this is the type of things that's going to happen, is that you get these support levels that look like they're holding, but until we get that 5-day moving average flattened out and the market can make a series of higher highs and higher lows above it, then we don't want to be involved. This is what we want to see happen, is we want to see that 5-day moving average flatten out, and then we want to see the market get back above it. That's not going to occur. We can still get a good bounce up towards that 5-day moving average. I mean, right now it's at 129. Here we are almost 3 points away from it, or 2.5%, which would be a great bounce. But for all but the most aggressive traders, it's really not something that you should pursue. And in fact, for all but the most aggressive traders, this market is not something that you should be involved in. Well, we have all this uncertainty. The market has been sending us very clear messages over the last couple weeks, and if you listen to that message and what we've been observing here is that we've seen these gaps lower, and then a more neutral environment that we had seen, and this was our range. We broke below that range, obviously with a gap, and what a lot of people were calling that symmetrical triangle. We broke down through that on the gap with the earthquake, tsunami disaster, and we've continued to sell off until this market finds an area where there's potential support. You can look at all kinds of things to justify taking a position. So for instance, today you could look at that 100-day moving average and say, well, the 100-day moving average is there. It should act as support. You could also take a look at the Fibonacci from the most recent move. That is, from these lows back in November up to the high for the year, we've just pulled back and retraced 50% of that movement. So you could say, well, 50% retracement, maybe that's a good place to stick in your bid. But there's still no advantage on the shorter term time frame. It was interesting today that the SPY did get right down precisely to the daily S2, and that's something that we were looking at in the chat room, not necessarily as a place to buy to get long, although hindsight tells you, of course, that it would have been a nice place to get long, and it bounced right up to the volume weighted average price. Instead, it was a good place to cover shorts. If you're super aggressive trying to look for every tick, you're going to get chopped up in a market like this. But if you can get yourself aligned with what is the intermediate term trend, which is lower. We've got a declining 5, 10, and 20-day moving average, and we're also below what's now a flattened out 50-day moving average with potential for bigger resistance up near about 130. So this market is going to need a bit of time before it can really heal. We've basically really given up the gains for the year. We're not negative for the year, but we're basically there. If we take a look at where did this market close December 31st? It closed at my eyesight's bad. 25.75 it looks like. So we're still up. It was at 43 cents for the SPY at least year to date. And on this computer, I can't see if anyone's messaging me because Twitter's on here. I don't have StockTwit's desktop on it. So let's just continue to take a look at this market. It was interesting. Last night I had posted a chart of the U.S. dollar Japan pair, and you can see here that what I was talking about was the low from 1995 was 79.800. Well, we did undercut that today. We had a low in the Japanese yen dollar pair, I guess that's what you call it. And I just opened an account recently in these future Forex, and man, they just are insane. Anyways, we had a 757 low, 79.757. So the yen took out the 1995 low. That's as far back as my data goes. So this is I actually didn't even realize that the yen was in such a downtrend for such a long period of time. But anyways, just kind of an interesting thing to look at. There was the yen at that low, which kind of makes sense, I guess. But let's look at. I'm not an expert in the news, but here's what I do know. I'm an expert, I think, in analyzing price action and listening to the message of the market. That's something that I was saying over and over and over again as people would send me emails and tweets saying, hey, this market's topping out, it looks like. And I'd say, no, it's not topping out. We were making a beautiful pattern of higher highs and higher lows. This was the first shock wave. Then we had another. Actually, the Egypt was the first shock wave. Then we had Libya. Then I forget what was this Saudi Arabia. I don't even remember what that one was. But the point is, we've had all these events. The market absorbed them on the way up, and then it became neutral, and now it's becoming more bearish. The market doesn't turn from bullish to bearish overnight. You could argue that, well, yes, it did. Right here was the evidence, and I got short that day, and I'm the superstar. But that's not what it's all about, because the superstar probably called this a top and that a top, and every little red candle in between a top as well. Instead, if we look objectively at price action, we say, what we always say is, if we want to look at these key levels of support. If support breaks, then the market sends us that message that it's time to become more defensive. The market has been sending us messages with a lot of these technology names imploding and not coming back. We had spoken about NVIDIA. I had spoken about I was talking about Decker's Outdoor at this point right here, and this was about 2 weeks ago. I said, look at Decker right here, and now look at NVIDIA, and look at the similarities at this point. Here's a stock we want to watch for a potential reversal. I didn't say we wanted to buy it. I said we wanted to watch for a potential reversal, and this is something we spoke about on this show as well last week. But the evidence of a reversal never came. If you take a look at, so for instance, on that daily chart, this level here was about 20 and a half. Well, if you take a look at where were we at 20 and a half, we were still below a declining 5-day moving average. And last week I was talking about what we wanted to see occur was kind of what I had outlined in the so, with the S&P earlier, which was that we wanted to see the market hit that 5-day moving average, come up through it, find support, and then turn higher, and then that 5-day moving average would have moved higher this 10 and 20, but obviously it didn't occur. So the point is, if you listen to the message of the market, what you want to do is anticipate all potential scenarios, watch the market carefully, and then wait for price confirmation before you actually participate. We had spoken about LZB, Lazy Boy, for a couple weeks, about how you don't want to buy a pullback to a rising 10-day moving average, but we wanted to look for evidence that it was turning sideways back above the 5-day moving average and turning higher. Well, the 10-day moving average didn't hold as support. Then we were watching it in here saying, hey, it looks like it's starting to turn sideways. But what do we want to do? We want to wait for evidence that the intermediate term trend turns higher before we actually buy it. So if we take a look at that 30-minute time frame in here, what we were looking for, this red moving average, we wanted that red 5-day moving average to flatten out and then make a higher high before we participated. So we were anticipating, we looked at this and said, here's a higher low. Now if we can get a higher high, this is what we'll be looking for in Lazy Boy, and perhaps it can go back and test this level up here near about 11 and a quarter. Well, what happened? Well, the market went lower instead. So was it a bad plan? No, because we didn't implement it. We were watching, we were stalking, we were waiting. We weren't participating until we had the evidence that the buyers were in control. We had the same situation in ELOS. ELOS was looking like it was finding support at that 20-day moving average. In my mind, let the institutions do the dirty work. Let them accumulate all the shares at that 50-day, the 10-day, the 20-day, whatever moving average. Let them accumulate. We'll watch and observe and then wait for a higher high above a flat to rising 5-day moving average. So we were looking at this one earlier, late last week, and it might have even been on the watch list for Monday, I don't remember. But what we were looking for was something like this to occur, and then as it makes the higher high here on the short-term 10-minute time frame, it would have been in alignment with this uptrend on the daily time frame and in alignment with the trend on the weekly time frame. Now you can look at this and say, it's pulling back, that this resistance is going to be support, and that's a dangerous game. A lot of stocks are failing right now. Let's see if it fills in this gap. Let's see how the 50-day moving average holds. But right now, the short to intermediate term time frame is still lower highs and lower lows below the dominant moving average for the intermediate term time frame. The dominant moving average for the intermediate term time frame, the moving average that you want to spend most of your attention focused on for swing trade setups, is a 5-day moving average. Now, on a daily time frame, typically a 50-day moving average is the dominant moving average. On a weekly, it would be the 40-week or 200-day. Obviously, that changes. For instance, like I said, on the SPY, we wanted to start looking at, I had been looking at just a 10, 20, and 50-day moving average. Well, it's necessary now to look at that 100-day moving average, because that's what the market is telling us. The market is trying to find some support near this level. It hasn't shown that it is finding support. We still have lower highs and lower lows below a declining 5-day moving average. Guilty till proven innocent. Let this thing bleed out. There's no need to be early. There's no need to be the first one in there. As I said on Twitter today, this is the type of market right now. In fact, a couple of weeks ago, I was saying over in here, the market we had back in first couple months of the year was the type of market that allows you to develop poor trading habits, to think that they're always going to come back after each one of these. I see Joe Fahmy points it out all the time as well. But it creates sloppy habits. Listen to the messages of the market and say, what are the key levels? If we break below those key levels, am I just going to sit there with my thumb up my ass, or am I going to take action? You need to take action. You have to listen to the message of the market and do what's necessary. I've been talking about MCP, the rare earth play. They did a secondary back in here. It kind of looked like it was maybe going to get going. Last week I bought puts in this stock, and it's been the right thing. And people have been pointing out to me, well, the rare earth story is about this fundamental shortage, and China's withholding minerals, and look at their revenues, and look at all this stuff. And that's all good and well, but look at where the stock has come from. It's already had a run from $10 to $65 a share. A little bit further pullback down to the 200-day moving average. That's where I covered my puts yesterday, down near that 200-day moving average. Those are the types of things we want to look at. It breaks important support, and when that support is broken, what's the psychology of those that are long? Well, you had time to get short. I can't short this stock. They didn't have it in inventory, but you had time to buy puts and to participate, and take advantage of these types of setups because they're out there all over the place. And I've been talking about MCP because RE has been hurt really badly lately. SHZ has really been one of the worst of what are considered the major rare earths. AVL has been hit, and it just seemed as though this one was holding up too long. The pressure was building. They did that secondary, and that put a lot of pressure on the stock, and it finally cracked. So those are the types of trades you want to look for. If you take a look at, I saw a lot of chatter about IBM today. IBM's been in this huge uptrend, and where did it come to? Right up to that 100-day moving average now, or down to that 100-day moving average. Some people bought here on the open yesterday because they thought, hey, it's at the 50-day moving average, and it's at support. Well, that support got broken. We dropped down where? To the next potential level of support. It doesn't mean this is going to hold. Maybe we're going to go down to the 200-day moving average in these markets, in IBM and in stocks like Apple, which have been bulletproof, down, was it 4.5% today? Where? To the 100-day moving average. So you take a look at these early on in the uptrend. It's typically the 10, then the 20 that holds the support. Then you get the 50 that bounces a couple times. Now, it's likely that this would be an area where Apple could bounce from. It's the highs from late last year. It's this prior support. It's the 100-day moving average. But when you look at the shorter term time frame, does it look like it's starting to turn around at all? Beyond saying, well, it had this rally and this could be a higher low. That's just there's not enough evidence yet that this market is turning higher. So I think you have to stay away from a stock like Apple. Apple could maybe head down towards $300 a share, down towards the 200-day moving average. I think that would be a good thing for Apple. Another 10% down. It would be it'd be something that would like I said, I think it'd be good for it. That would bring it down close to, actually right to this longer-term trend line from the 2009 low as well. So I think there's still danger in Apple. I think if you're one of these Apple fanatics, then here's where you want to look for the potential that the stock begins to turn. But the evidence simply isn't there yet. If we take a look at the semiconductors, I've been talking about the semiconductors my whole career for at least the last decade, because they typically lead the market. They led this market higher this last run. They were the clear leader, leading the Nasdaq and the S&P, and then they ran into trouble, broke that trend line, and they broke below the 50-day moving average and closed below it first. I got emails from people that said they were buying here at the 50-day moving average. I told those people, good luck. I don't think it's ready yet, and still it's still not ready even at this 100-day moving average. You can look at it and say, well, doesn't it make sense that it should find support? It should find support. It's got the potential to find support there, but God forbid anything happens catastrophic with those reactors. None of this stuff is going to matter. We're going to revalue a lot of things. You have to look and wait for the evidence to emerge that the buyers are regaining control. So we have this clear pattern in the semiconductors of what? Lower highs and lower lows. We have prior levels of support becoming resistance. So right now an important level is going to be about $33.60. I think if we get a move up towards there and then a higher low, let's see, so then a higher low that kind of came like this, get that 5-day moving average flattened out. Then maybe above 33.60 we could get a bounce in the semiconductors, but to where? Where would the next level be? Maybe up towards 34 and a quarter. It's tough to trust. We've got a market that's just bleeding out here, so don't be the hero and buy into this stuff. Eventually you're going to get it right, I suppose, if you keep buying, but that's an expensive way to make money, and you're usually not going to. The odds aren't going to be there. We talked forever about these two levels in the financials, 1635 and 1620. Yesterday we broke down through that 1620 level, came close to that 100-day moving average, and what did we see today? We saw that $16.20 level, 1620 to 1635, that level, the prior support, did what? It became resistance. And if you were watching this thing, in the chat room this morning, I mentioned, hey, it's at that, it's right here. I said it's up to this prior level. It's at 1620, and from there it just backed right off immediately. So there are trade opportunities out there if you're paying attention to the right things, and if you're looking objectively at what the market is telling you. The market is telling you that we're still under intermediate term pressure. How long this selling lasts is anyone's guess. Just like anyone who tries to pick the top, anyone who's going to pick the low, or who will tell you what the low is going to be, is a liar. They have no idea. Maybe it's going to be this trend line from the August lows. If we throw some Fibonacci on the financials, you can see that that's also approximately a 38.2% retracement. It's approximately this prior level of resistance as well. So maybe 1570 is going to be important. I'll tell you this, I'm not going to be the dope that tries to buy it at 1570. It might be the best buy of the century, but I'm not going to buy it there, not while it's going down. I would rather see it go to 1520, and then I'll buy it at 1570 after it begins to bounce. But trying to pick the bottom is it's a loser's game. Anyways, that's going to do it for today. I'm sorry my Twitter seems to be having issues. Otherwise, I would look to see if there's any comments or questions. But we'll do it again on Friday. Hope that everyone's getting through this tape okay. And if you're overseas somewhere and have someone, a loved one in Japan or whatever, best for everyone over there. Thanks for tuning in.